The outlook right now, you've warned of many things. Don't confuse a rebound in global economy with recovery. But I think as we go from 2020 year of pandemic to 2021, the year starts with virus cases resurging, with vaccine rollout being spotty and slow in some cases. And then we've got this chaos in Washington. How much does this affect, if anything, the World Bank's view, your view of the global economy, and certainly how the U.S. will or won't drive it?
So, you know, as you pointed out, I've been emphasizing don't confuse rebound with recovery. The World Bank projections is for a rebound. However, a rebound this year still leaves per capita income per person, below where it was before the crisis, before the COVID crisis. So calling it a recovery is misleading. Now, I'm glad you brought up the issue that here we are a year later, and we're still right now facing, record infection rates. The longer this goes on, the more disruptions in terms of jobs, in terms of closures of businesses that can't really get back to anything resembling normality. And so, you know, when people hear the term financial crisis, the first thing they think of is a Lehman moment, you know, a lot of drama, a lot. I'm not talking about that, but I am very concerned that the longer this goes on, the more strain on balance sheets of individuals, of households, of firms, of countries, and it's a cumulative toll. Mm-hmm. And that I think has, at least historically, you know, this does not start as a financial problem. This started and continues to be, first and foremost, a health crisis.
Right.
But it has elements that have morphed into your classic balance sheet problems.
Well, let's take a look at that, because stock markets are rallying in many parts of the world. We've had, you know, optimistic equity strategist after optimistic equity strategist speaking. So what is the mechanism? How do you get from where the economy is now, numbers are picking up, jobs even coming back in some countries, to this debt-driven, financial fragility-driven crisis that you say is brewing right now?
So look, equity markets are being very much fueled by the expectation that rates are low for long, right? That central banks in the advanced economies will continue to do whatever it takes, in the famous words of Draghi, Mario Draghi, whatever it takes to have ample liquidity to do everything in their power. There also it has been, enthusiasm about vaccines, enthusiasm about a fresh round of fiscal stimulus. But the reality is, the job numbers in the U.S., look quite shaky. That most of the forecasts that we're also expecting more sustained momentum going into this year are being marked down because of the resurgence. Whether you're calling it a second or third wave, depends on where you are. That is, I think, given all the drama that we are seeing, ranging from the drama in Washington to, the whole, environment in which we are still in what are almost unprecedented in this past year levels of uncertainty. There is this problem that has been delayed but not avoided. Mm-hmm. In terms of households' ability to repay their mortgages, their ability to repay their debts. And this is not a country-specific problem. This is very generic across countries. Let me just note that besides the headline fiscal stimulus, besides the headline monetary stimulus, a big source of stimulus this past year has been that financial institutions across the globe in varying degrees have also agreed to grace periods, in which businesses and households don't repay their debts. What happens when those programs come to an end?
Carmen, just continuing on the theme of debt, I want to throw up this chart. And as you say, this is a global problem. This is not something that only affects, one emerging market or one particular central bank. But just taking a look at China, this is a well-told story about their debt to GDP, right? Corporate debt making up the most of that at around 200%. Total debt has risen to over 300% of annual economic output. We know that in India, public debt to GDP is about 90% as of towards the end of last year. My question, though, is what does productive debt look like? Because isn't the concern that we're continuing to add to these balance sheets, be they private or public, but we're not getting the growth or the productivity that you'd want for that amount of debt?
Well, look, let's start with the China case. If our frame of reference is the last crisis, it was called the global financial crisis, the 2008, 2009, but it really wasn't global, okay? It was about a dozen advanced economies that had serious problems in their financial sector. It was by no means global at that time. China was growing double digits, and China was a major engine of growth for the emerging world, which is right now over 50% of global, well over 50% of global GDP. Okay, that kind of engine of growth translated into high commodity prices, a lot of lending from China to including a lot of the poorest countries. That is not the environment that we're in right now. So I ask you, who will be the engine of growth? And at the moment, China is certainly doing much, much better than most of the advanced economies, but it's a far cry from the vibrant kind of, double-digit phenomenal growth it had a little over a decade ago. I think when we think about debt vulnerabilities, one really has to go back to the proverbial canary in the coal mine, which are the countries that already came into the COVID crisis with very weak fundamentals, and some of them already in outright crises. Well, a lot of the very poor countries fall into that category. They're just not the headline kind of we hear about the major emerging markets, the Chinas, the Indias, the Brazils, but there is, an increasing wave, if you will, at this stage of debt problems of countries that are already facing debt difficulties or are very close to one at the sovereign level. And again, at the corporate and household level, that is also a big issue in varying degrees.
So what further institutional help can there be or should there be given by the likes of the World Bank and the IMF to some of these, as you say, most vulnerable economies?
Well, look, the cure or the remedy depends very much on the disease. I think, for the more general issue that I've raised of financial fragility, which cuts across advanced economies, middle income, and low income in terms of household debt, corporate debt, I think a lesson from history, if you look at how some of the banking problems have been resolved, speed is of essence. That is, you don't want to create zombie companies. You don't want, a lot of liquidity can help businesses and households through a tough period, but liquidity does not address insolvency.
So,
okay,
Carmen,
so and at the corporate, that's at the corporate level. At the government level, it is debt write-offs starting again for the lower income countries.
So where are we going to see this first? Central banks have kept their key rates low, 0, maybe even slightly negative. They've keep, buying all kinds of bonds to keep their yields low. As you said, there'll be a day of reckoning when things pull back. Where do you expect to see this debt crisis that's so quiet now become loud? When does it really be apparent? Where do you see it happening first?
Look, again, you don't necessarily need a big blowout, a big Lehman moment. I think Europe, coming out of the 2008-2009 crisis, had an almost decade-long credit crunch that meant very sluggish recovery, and that is a big source of concern. Okay. It is not, the major blowout, the big headlines. It is institutions that have a lot of non-performing loans, a lot of bad debt, are not able or willing to lend as readily, and recovery from this needs new lending. Okay. And so that's the credit crunch dimension of it, that again, it's to some degree without big drama.
But Carmen, this leads to something else you've highlighted, that as all this big stimulus and rates and bond buying helps some bigger corporations, some of whom would probably be insolvent by now, but they've been held up. But it makes it harder, you point out, for the small and medium-sized businesses, for households to get money. How is that part of it going to work out? What can the World Bank, what can anybody do about that part of it?
Well, look, in two dimensions, the World Bank, in particular, the International Finance Corporation, IFC, works a lot on restructuring. Restructuring small businesses, medium businesses all over in, not every corner of the world, but in a lot of them. So that's one dimension of the resolution. The other dimension of the resolution, if you go back to the recent G20 initiatives, is the agreement towards a common framework for debt restructuring for helping those countries that are having an insolvency problem, not a liquidity problem. We can't ask central banks to take care of all of this. As I said, they can provide liquidity. That doesn't deal with the problems when there are insolvencies at the household, firm, and sovereign levels.
Carmen, we've seen, at least in the US and certainly across other economies as well, much closer working relationship with the central bank, with the Fed and the Treasury. Do you think this closeness should actually continue even in a post-COVID world?
I think it will for a while. I think that, look, in a world of more rapid growth and lower debt, central banks can, to their heart's content and to their mandate, be very focused on the inflation, the financial fragility concerns. Right now, the financial fragility concerns are very tied to the slow growth and to the high levels of private and public debt. So I think we are going to be in the post-pandemic, we already started down that path after 2008, 2009, with, I would say, central banks doing a lot more fiscal policy than any time since, the wartime era, World War II I'm talking about. I think that close connection between the fisc and the central banks will be with us for a while. A lot of my work has focused on the term financial repression, which sounds really sinister, but financial repression is about a big presence of central banks, and more regulation, and also very low and in many instances sustained negative ex post real interest rates. We are seeing that.
Right.
We have been seeing that for a while. I think that's the environment that we will be in for a while, because again, I don't think that we are in for the kind of recovery
Right.
that you can say we will, a year from now, we will be having this conversation and it's all behind us.
Right. Carmen, another thing you've highlighted in your work, certainly it's a major issue for the World Bank, is income inequality. It seems to get worse in every financial crisis that you write about and analyze. What has the World Bank done? Say in 2020, what was the biggest thing the World Bank was able to do to push back against that? What did you fail to do? What do you want to do this year?
Okay, so I think an important action or set of actions by the bank has been lending, especially earlier this year when financial markets really tightened up, and even now, private capital flows are quite skittish to a lot of the middle and lower income countries. It's much more selective than it was. And that lending is not indiscriminate. Very much that lending has been focused. Yes, there has been considerable lending to provide general budgetary support to deal with the emergency, but much of the World Bank programs are geared towards social protection, i.e. building and strengthening social safety nets, cash transfers, and the like. These programs target the most needy, and it is an offset. But let me say that when I say an offset, it is an imperfect offset, because this crisis has been, this shock has been the much more aggressive than what I would call a more standard financial crisis, because, who can work from home? Again, going back to the businesses, the small businesses often don't have access to the kinds of local government programs that can provide support. Small businesses also lose access to new credit much more readily. So this has been a very regressive crisis across, within countries and across countries. So the World Bank's focus has been within country, provide support for social programs, and across countries, focus with the debt suspension initiative on the poorest countries, the so-called IDA countries, which are the list of 74 poorest countries that are eligible for debt suspension, which essentially allows these countries to take, at least temporarily, to take whatever savings temporarily they have from debt repayment and use those funds towards COVID-related emergency needs.